Hello everybody, this will be a video on risk management. In my opinion, risk management is one of the most important things when it comes to trading asset in any asset class, whether it's stocks, crypto, or Forex. If you guys enjoy any of this video, please give me a thumbs up and subscribe. First and foremost, when trading, you want to make sure that you are only risking 1% of your capital, especially for beginner traders. Advanced traders can get away with risking 3 to 5% of their trading capital, but I highly recommend 1%. The reason being for when risking 1% of your capital is that it is a small loss to your capital and it doesn't require you to trade extensively to gain it all back. Now, coming from this picture here, coming back from a loss, this is kind of a brief intro into what I'm describing. A 10% loss from your overall trading portfolio means you have to gain a 11.12% gain to recover from that previous 10% loss. Now, this may sound kind of minimal at first, but it really adds up when you start losing more and more of your account. And hence why when risking, you want to only risk 1%. Say if you only lose 1% of your trade, you only need to gain back about 1.1% to be back in break even again. Whereas if you are risking, say, like 10%, 20%, and you happen to lose that trade, well, now you have to have 25% to a 42.86% gain just to get back into break even and have your portfolio back to where you started. Now, as you take more trades, you will notice your historic win rate and kind of get a feel of how many trades you are winning versus how many trades you are losing. For beginners, you want to know your risk to reward ratio, which will be a determinant in what trades you take and how much risk you're willing to take versus how much reward you want to take. And so this is determined by a stop loss. A stop loss is a place where you put in case your trade gets invalidated, where price is heading south. And so it's a way of stop losing money in a trade, whereas your take profit is how much you want to gain from the trade. And so for starters, having a 50% win rate means you can take a risk to reward ratio of 1-to-1. And so if you're winning half of your trades, you can risk 1% of your capital per se to gain 1%. And so it goes on towards, if you have a 33% win rate, now you want to be looking for a risk to reward of 1-to-2, where you're only risking about 0.5% of that 1% to gain a reward of twice the amount that you're risking. Same as goes when you have a, say, 25% win rate. You want to be looking for a risk to reward of 1-to-3, where you're making 3 times the amount that you're risking when you are putting it into a trade. Going off risk to reward, let's do some real trading examples. Let's say if I were to long right here, for beginner's sake, let's just say I have a risk to reward ratio of 50%. And so with this, this is just an example. I'll put my stop loss, say, at a 1%, or in most cases, you would want to put your stop loss and calculate it out beneath a support. And but for this demonstration purposes, I will use a 1% stop loss. And so let me drag it out. All right, 1.1. And so what I want to reward, or what I'm hoping to get out of the trade, is a target of 1%. And so as you can see here, my risk to reward is 1, where I'm risking 1% to gain 1%. And so that is a common example. Now let's do another example. In this example, let's just say I have a 33% win rate. Well, what I want to do is risk 1% again, or it can be 0.5%. I'll do 0.5% in this case. Again, I recommend putting your stop loss below a support in this case, not just a percentage. Therefore, it will be a better trade in my opinion. And so in this case, I am hoping to gain 1% out of the trade. And so let me move my target up to 1%. And boom. Let's say I am willing to risk 1%, and I'm still a 33% win rate. So I'll move my stop loss down 1%. So much I'm willing to risk. But I want my win rate, my target, to be 2%. So I'll move my target up to 2%. Usually with targets too, is that I recommend targeting a local resistance to make the trade a more profitable and proficient one. Now, the next thing I want to talk about is leverage. Leverage is a way of adding more onto your trade to speed up the percentage and the gain or loss. Hopefully you're gaining when doing a trade. Now, leverage scares most people, and with some people, they get a little too greedy with it. And so I kind of want to explain the misconceptions on it and kind of explain how you can use it to your advantage when you're being smart about it when it comes to risk management. Now, for example, if you have $1,000 in your trading account, your total portfolio, you want to risk 1%. So I'll do 1,000 times 0.01. So you are risking $10, which is 1% of 1,000. And this is good risk management. Now, say if you use 10x leverage, so multiply it by 10. Now you're using about 10% of your trading capital, but yet you are risking only 1% of your total portfolio. See how it kind of adds more power to your trading? And so this is a way that it can be both deadly and both very useful to you. Now, when using leverage, you want to keep in mind of the fees that come behind it, along with a liquidation price fee. Hopefully you aren't getting liquidated. Hopefully you're putting your stop loss before you get liquidated to avoid the liquidation fee. But anyways, let's do another example. So with $1,000 in your capital, you want to risk only 1%. And so if I want to put on 100x leverage, multiply it by 100, I am now putting on $1,000, which is my total portfolio in a way. But yet I am only risking 1% of my capital. So now going back to my risk to reward example, let's say I am using a 1% stop loss and I have $1,000 in my account, right? And so to risk only 1%, so it'll be $10 again, I will use 10x leverage, in which I am putting my whole account. So I am putting $1,000 on, and with my risking or my stop loss, if I get invalidated, I only lose 1% of that 1,000. And so I am putting basically my whole trading account on just to risk 1%. And so with this, the risk to reward in most cases can be fantastic. I hope this video was of great use to you and helped you determine in risk management and that deciding that risking 1% of your trading capital won't necessarily hurt your capital, but will make you a profitable trader in the long run, especially if your win rate is 50%. Just to go over and recap, the first things you want to look for when entering a trade is your target entry, which is like reason for entering the trade or whatnot. Of course, your second wants to be your invalidation point. And so this can be your stop loss. And remember, your risk to reward ratio determines where to put your stop loss. And what you want to do is put your stop loss, say, at a certain percentage, which I don't really recommend, but putting it underneath a local support. So I'll write down local support level. And with this, you want to determine how much leverage you are using. For the most part, it doesn't really matter how much leverage you are using, but always remember you want to risk 1%, and you do not want to be liquidated. So I would recommend putting your stop loss above your liquidation price. Anyways, if you guys enjoyed this video, please give me a thumbs up. And also, I will leave a link in the description where I post all my trades. Thanks. Bye.